5 years of investing and holding this fund taught me something books alone could never teach me. Knowing the theory of long-term investing and actually living through it are two very different things. In March 2021, as a complete beginner, I started investing in the Vanguard Emerging Markets stock index fund. Over the next couple of years, I cut my monthly contribution, then stopped adding new money altogether, but I never sold a single unit. Then, in its 5th rolling year, the fund jumped almost 48%. Today, I want to take you through what happened during those 5 years and the 3 lessons that helped me become a calmer, more rational long-term investor. Hi, I'm Cici, a chartered certified accountant with a master's degree in finance. I break down personal finance and UK tax and share honest lessons from my journey towards financial independence. Let's get into it. So why did I buy it in the first place? Back in March 2021, most of my money was invested in S&P 500 and FTSE All-World ETFs. But I wanted a little more exposure to emerging markets. Higher potential growth, slightly more risk. Classic textbook logic. So I set up an £80 monthly direct debit into a Vanguard Emerging Markets fund inside my stock and shares ISA, just 10% of my monthly ISA contribution. It tracks the MSCI Emerging Markets Index and invests in roughly 1,200 companies across a range of emerging markets, rather than relying on one company or one country. Broadly diversified. I told myself, I'm ready for the volatility, or at least I thought I was. What I hadn't considered was how I'd feel when that volatility didn't last for a few months, but dragged on for years. Not long after I started investing, the fund began to fall. At first, I wasn't worried. I had read the books. Markets don't go up in a straight line. I kept telling myself, this is completely normal. I'm a calm long-term investor. Then 1 month passed, then 3 months, then 6, then 4 years. And the fund still hadn't recovered. In my first year, the fund's unit price was down about 10%. But the loss itself wasn't the hardest part. It was how long the uncertainty lasted. Month after month, I looked at my screen and wondered, am I being patient, or am I just refusing to admit that I was wrong? For the first time, I wasn't just questioning the market, I was questioning my own judgment. That doubt changed what I did next. After the first year, I reduced my monthly contribution from £80 to £30. At the time, I saw that as a failure. I knew the usual argument, when prices drop, the same amount of money buys more units. So, if I still believe in the investment, surely I should have continued contributing the full £80. I understood that logically, but emotionally, it was much harder. £80 was the amount chosen by the confident version of me. £30 was what the real, more anxious version of me could actually live with. Reducing the amount gave me some breathing room, and because I made that adjustment, I managed to keep buying for another 14 months. Without it, I might have stopped much earlier. Before this experience, I thought investing had only 2 options: follow the original plan perfectly or give up completely. But there was a third option: adjust the plan. That doesn't mean you should reduce your contribution every time the market falls. It means making your plan easier to follow when things get tough, so you can keep going instead of walking away. Reducing the amount helped me stay invested for longer, but it didn't remove the doubt that was building underneath. In my second year, the fund dropped again. During the first year, I could still tell myself that patience was part of long-term investing. But as the second year continued, I became less confident. Then I started to realize something else. If my S&P 500 or FTSE All-World ETFs dropped this much, I would have kept buying without blinking. Why? Because I understood them better, I had a much clearer idea of what they held and how they might grow over time. With these emerging markets funds, my knowledge was much more limited. I couldn't answer basic questions with confidence. Why had it stayed weak for so long? Was this just a normal part of investing in emerging markets, or had something fundamentally changed? I didn't have a clue. And when you don't really understand what you own, price can become the only thing you rely on. And every fall starts to feel like proof that you were wrong. By April 2023, I stopped adding new money. But I never sold a single unit, and that decision was about to matter more than I ever expected. The fund didn't suddenly shoot upwards as soon as I stopped contributing. The recovery took time. It happened gradually at first, then came year 5. From June 2025 to June 2026, the fund returned almost 48%. After years of disappointing performance, that was the massive jump I'd waited years to see. I was relieved that I had never sold. Then I looked back at the data, and the painful truth hit me right between the eyes. Those 14 months when I cut my monthly contribution to £30, they included some of the lowest prices in the entire 5-year journey. Fear cost me the chance to buy more units at a discount, but cutting my contribution to £30 had also kept me from giving up entirely, and more importantly, it allowed me to stay in the game until that 48% rebound eventually came. Of course, at the time, I had no idea when or even whether that rebound would come. But this 5-year experience did show me that I had fundamentally misjudged 3 things. The first thing I misjudged was my own risk tolerance. Before I bought this fund, I'd read books. I knew markets could fall. I honestly thought I'd stay calm. I thought I would keep buying, and I thought a long-term mindset would protect me from doubt. But that belief was based on an imaginary version of me. A version that had never actually lost money. You see, risk tolerance isn't how confident you feel when markets are rising. It's about how you behave when an investment keeps disappointing you for much longer than expected. That is especially important if you are a beginner. You may understand risk in theory, but until your own money has been through a difficult period, you may not know how much uncertainty you can genuinely live with. That doesn't mean you should avoid all risk, but it may be better to start with simple, broadly diversified investments that you understand and feel confident holding. That gives you time to gain real experience before deciding how much extra risk you can genuinely handle. The second thing I misjudged was how well I understood what I owned. I knew the basic facts. It tracked an index, it held companies across several emerging markets, and it was likely to be more volatile. But my understanding stopped there. I didn't fully understand where its long-term returns might come from, and I didn't understand all the reasons it could remain weak for years. That became a problem when the price kept falling. Because when you don't understand an investment deeply enough, price can become the only thing you rely on. If the price rises, you feel confident, but when it drops, you start to wonder whether you've made a terrible mistake. The problem is, price alone cannot tell you whether the investment case has changed. That is where proper research becomes important. Good research isn't there to convince you that the investment must go up. It should help you answer some basic questions, like what does the fund actually own? Where might its returns come from, and what are its biggest risks? Understanding those things won't remove uncertainty, but it gives you something other than price to rely on when things become difficult. And that can help you make more informed decisions when markets fall. The third thing I misjudged was my ability to follow the original plan. I designed that plan when I felt calm and optimistic. I hadn't experienced a long period of disappointing performance, and I hadn't yet seen how doubt would affect my decisions. £80 a month looked reasonable when I started, but once the uncertainty became real, it was more than I could comfortably live with. Reducing it to £30 gave me some breathing room. Looking back, it had a downside. I bought fewer units while prices were low, but it was a plan I could follow for another 14 months, and it helped me avoid walking away completely. That changed how I think about investment plans. A good plan isn't one that looks perfect on paper. It's the one you can still follow when markets become uncomfortable. So today, before I put money into a more volatile investment, I ask myself one question, and it may be worth asking yourself too. If this performs badly for 2 years, can I still follow the plan? If the honest answer is no, the amount may simply be too large, or the investment may not be right for you. Because a plan only works if you can keep following it when your confidence is tested. If I could go back to March 2021, I might still invest a small amount in emerging markets. But I would take more time to understand the fund. I would expect difficult periods to last longer, and I would choose an amount I could realistically stick with. That 48% rebound doesn't mean every falling investment will recover within 5 years. But it did show me that long term can be much longer than a beginner expects. And because I stayed invested, I was still there when the rebound finally came. Books taught me the theory of long-term investing. This fund taught me what it actually felt like. And that experience made me a calmer, more rational investor. This video is based on my personal experience and is not financial advice. Have you ever changed your investment plan during a difficult market? Let me know in the comments. If you found this useful, don't forget to like and subscribe. Thanks for watching, and I will see you in the next one.